All right, welcome everybody. I'm going to wait till the participants plateau here as I see people rolling in, but this is just to make sure everyone's in the right place. This is Research Challenges in Asset Management. The purpose of today's session is to ask two of the giants in the field of asset management their thoughts on what research in asset management from academia could help, and what are some of the pressing issues and challenges that could spur academic research, and that hopefully we can have some impact on the practice of asset management. So let me start by introducing our esteemed guests today. I want to welcome Cliff Asness and Ken Griffin. Just a couple of quick bios for both. Cliff is a founder and managing principal and chief investment officer at AQR Capital, one of the largest hedge funds in the world and a leader in quantitative investment strategies for the last 22 years. Cliff is also an active researcher, having authored many papers on a variety of financial topics, not only in the Journal of Portfolio Management and Financial Analyst Journal, but also the Journal of Finance and the Journal of Financial Economics. He's received numerous prizes for his work. In 2006, he received the CFA Institute, presented him with the James R. Burton Award, which is given to individuals who have produced a body of research notable for its relevance to the practice of investment professionals. Ken Griffin, founder and CEO and co-chief investment officer of Citadel, one of the most respected and successful investment firms in the world. Today, Citadel manages more than $36 billion in capital, and it's celebrating its 30th anniversary. So congratulations on that. In that time, Ken and his partners also built Citadel Securities, one of the world's largest market makers, whose goals have been to improve financial market competitiveness and transparency globally. So I want to welcome both of you. Thanks for joining us, and I know people are excited to hear your thoughts. Let me start with sort of an open-ended question, and you can decide which one of you wants to start first. But what do you think are some of the key unanswered questions in asset management right now, and which academic research could be helpful in answering? So sort of full space here.
I'll take a shot at it. First of all, you managed to call both Ken and I very, very old in your introduction. You told Ken he has a 30-year-old firm, and you told me I won a Lifetime Achievement Award 16 years ago. What do you know? But that's for another day. We'll talk about that offline. One thing that has to be frustrating is almost by definition, if you ask me where academia can help asset management, where it can move the dial, it's going to be in the very hard areas. I mean, the collective we, everyone listening to this, the three of us, we haven't skipped easy stuff that would be helpful. We've, if anything, I won't say skipped, but what's out there is hard. So one is anything to do with a structural break. You know, I'm in the midst of a 3-year period where multi-factor quant investing, this is one presentation where I probably don't have to explain what that is having a terrible period. So I get asked the question all the time, has the world changed? I try to explore, and as a firm, we try to explore, every singular story, one-off story for why the world has changed. And I'll tell you, our method is generally, if we explore everything and can't find a reason it's changed, we stick with what we're doing. But that doesn't mean we're right. We don't really collectively have the tools to really get at structural breaks. And it's inherently hard, right? You get to see one COVID, hopefully in our lives, we all get to see one COVID. As a statistician, we would like to see thousands of COVIDs, because then we could actually figure something out, but then we'd all be dead. So that's probably not a good plan. The other thing, and I'll turn it to Ken, is any of the real world constraints. People have worked for a while on this, how information actually gets into stock prices, how liquidity matters, but that's still well behind everything else. Mundane stuff, like, how does it matter that I can promise you, it's much more difficult to stick with the same strategy that you do a back test on, and you look at a terrible period and you go, well, look, it came back. We know we'd stick with that. No, you don't. It's actually much harder real time. That's obvious, but how that actually impacts the potential inefficiencies themselves and how markets clear, is not obvious. So sorry, I'm going on and on, but I'll turn it to Ken.
Ken, please.
So actually, I mean, Cliff's spot on right. In any investment strategy, there are questions of how is the world around us changing, and how does that impact the future expected returns of the strategy? The largest sea change in our life, I mean, by a landslide, has been the movement away from active towards passive. The AUM and passive, in particular in equities, has been exploding. And how is this reshaping financial markets, reshaping the assimilation of information into security prices? And I think this brings to the forefront some very important considerations in terms of how to maintain financial markets that are rich in price discovery and that are successful in capital allocation. And so, in some sense, work that was done years ago should be revisited to make sure that we are current and thoughtful, and in particular, thoughtful vis-a-vis policymakers. I'll give you a simple example. In a world of much more in the way of passive management, the role of short selling becomes much more critical to having the right pricing of equities. And yet there's been a dearth of work done on the value of short selling and the importance of the information flows that go with short selling into the formation of prices in asset markets. And in fact, what we saw in the COVID crisis of just a few months ago was countries around the world banning short selling, which is really interesting because what you're doing is you're taking that small group of active managers who are able to short, and you're effectively telling them that your business model is prohibited in periods of market turbulence, when in fact where getting price discovery right is incredibly important so that society can allocate resources correctly in the middle of that pandemic. The second area that we think is very interesting to think about is the intersection of an ever-increasing passive market and active management shrinking in terms of like, what is the equilibrium point at which this breaks down? At what point does passive become just so large that we start to run into problems with healthy market structures, with healthy equilibriums in price discovery? We're not there yet, and we don't know where that line may lie, but the world cannot end up 100% passive. And where do we stop before that point in the journey? There are some interesting questions that I think that Cliff and I would think about as longtime practitioners around incentive structures for asset managers. One of the interesting questions, early in our careers, the world was dominated by mutual fund managers, and their goal was to transform their excess returns into AUM because they were paid a percentage of assets under management. And all the institutional incentives for the asset manager aligned with growth in AUM. Now we see the rise of hedge funds as an important asset class, and that's all about incentive fees. And the interesting nuances that come with that is if you're up a lot of money come September, what do you do with your clients' assets in October, November, and December? What are some really thoughtful ways to structure the compensation arrangements between asset managers and the owners of assets to create optimality in behavior so as to maximize the risk-taking, the thoughtfulness of risk-taking, and ultimately the return to beneficiaries?
Ken mentioned passive versus active. I'll just add, of course, Ken's right. We had a podcast where we had Jack Bogle on, and I got to talk to him, and it was Jack who raised the rather obvious point, but to hear it from Jack Bogle that, we can't have 100% passive, that's crazy. Now, Jack very, very scientifically told me you can be 85% passive. Okay, that wasn't scientific, and he admitted it. He said he's sticking a finger into and of course he's pro-passive, so it was, more passive than today is like always the answer. But I get asked all the time questions about passive, and I check specific things. Like we think there are pretty large behavioral mispricings right now. Is that because of passive? So you can do one-off checks, right? Is it the mega caps that are driving that? And our answer has been no. to that, but that might be a hint that flows into passive matter. But some larger coherent theory on what it means, instead of having 80% of the market active, to have 80% of the market passive. Maybe that's enough, but maybe not. And Ken's is right. That's hard to research. And again, any suggestion we're going to have is going to be hard because we've all done the easy ones, but that would be really useful to the world.
And where that line lies will come down to how successfully can active managers employ the broadest array of strategies. So, for example, really good facilities for stock loan matter in a world where active managers are relied upon for price discovery. So the short sale bans, for example, of just a few months ago, really undermine the amount of money that can be put to work in passive. A financial transaction tax would do the same thing. Financial transaction tax would make it very difficult for active managers to drive towards the right price in the marketplace, particularly when the passive pools just don't trade. I mean, your market impact and transaction costs would just explode in a world of transaction taxes, which is a very in vogue concept right now.
Yeah, I mean, I think we're getting into policy. Maybe we'll talk about that more later. But transactions tax is a great example. I think the world of policy, not necessarily the academic world, but I'm trying not to make fun of politicians too much, but it's hard not to. You tell them price discovery is important and efficient pricing and accurate pricing is important. They roll their eyes. They think that's some theoretical thing we like to mention to justify our existence. And, you can argue with them. You can say, try to imagine a world where wildly inaccurate prices, an efficient stock market is one of the huge advantages of free enterprise. But maybe I'm just not convincing enough, but in my experiences, I have never gotten policymakers to kind of take that aspect seriously. They think it's Ken and I trying to protect our cushy jobs. So if academia could back us up on that a bit, I don't think it'd be too hard. That would be nice.
Well, let me follow up with that because I think it's a really interesting discussion, which is, what sorts of academic research do you think would help in this regard? In particular, one thing I wanted to focus on that you mentioned, Ken, which is more documentation of how resources get distorted when you have these frictions in the market, whether they're caused by regulation or whether they're caused by other frictions in the market, such as information asymmetry and lack of transparency and those things. Do you think to both of you, do you think more work on that needs to be done? Would that be helpful in this regard to look at the economic impacts of these things?
Yeah. I only heard him talk about this at a conference. I've not seen, I think he's written on it too. But Jensen made a point at one of the conferences I attended a number of years ago. Again, I'm old. I think he was referring to the tech bubble, not the current environment. I'm conscious of the fact that a lot of the people listening were in junior high at that point, which is, again, it's the last old comment I'll make. But he pointed out, and this jives very well with Ken's point on short selling, that imagine you don't believe markets are perfectly efficient. Wait, let me check. Is Gene Fama on this call? Because as his ex-student, when Gene's on the call, I lean heavy towards efficiency. But if markets aren't perfectly efficient and it's somewhat symmetric, they can be inefficient as a whole market or in individual securities on the up or the downside. Our mechanisms for fixing markets that are too cheap are relatively easy compared to markets that are too expensive, simply because going long is way easier than going short. So more research into that asymmetry. And Jensen talked about how being overpriced is far more deleterious to a firm. I mean, they're talking about the management, the decisions they make, to being underpriced. And I thought that was fascinating, and I think it's kind of slipped by the wayside. But it's all tied in. It ties in with the idea that short sellers do a positive service. But I do think more on this asymmetry, more on this idea that the real world is impacted by finance and investing. When things are over or underpriced, but again, that's easier to correct, it matters. People do silly things with our collective money.
So kind of continuing along this theme, just sort of a general question. In terms of how I want to ask both of you because I think people would be interested. How do your research teams consume academic research? Or it sounds like the kind of research you pay attention to might be on the policy side or certainly implication, but how well do you consume academic research and look to that for some of these answers?
I'll start. That's exactly our wheelhouse. There's no magic to it. I think if you go across my firm, we probably read everything. Anything in a quality journal, including practitioner journals that's related to investment management, somebody's reading. I think we have a real good culture about bubbling up things that might impact what we do. I think we foster a lot of ties to academia, both through some rather low-ranking, low-regarded professors who are affiliated with AQR. That was a Toby joke, by the way. No one seemed to get it.
I got it.
We get involved with awarding an award each year for best working paper, and then almost a standard operating procedures. If there is something that's quite interesting out there, the initial academic work, and you always want to be early, so hopefully you're reading something fairly new, is almost always on a fairly narrow subset of the world. Not always, but almost always. So kind of, plan A at AQR is always, well, this looks interesting and it might affect us. Let's see if it holds up at a sample in the next 22 places. It doesn't have to hold up everywhere, right? The net evidence in places they haven't looked just has to be decent. But that's a fairly standard playbook of ours that I think is the right one.
So Toby, I'm thinking like all my nights on Google Scholar or SSRN. Look, Cliff almost certainly has us beat in the rigor with which they go through work published by academia, but we place a huge emphasis on understanding the current body of work that's happening, whether it's in data science, econometrics, or machine learning. For us, time to market from TensorFlow to first impact in our trading was about 7 days. So we can move really quickly when we see what we perceive to be a game-changing evolution in the body of knowledge of humanity. Now, from my perspective, academic research is actually incredibly important both to level set and as a source of inspiration. Just a tremendous number of our ideas are not that we read a paper per se, but that the paper planted seeds for ideas that have borne fruit. And that ability to have, in the sense, a paper that you can read that's thought-provoking is priceless. It's like having a member of your team who you don't have to pay a separate paycheck to, who doesn't complain about the hours they have to work, but they certainly bring something new and interesting to the table.
Don't give them ideas, Ken. They're going to add to the transactions tax and academic tax.
Right. Thanks, Cliff. Appreciate that. Although I think both of us in our lifetime will have made a very clear statement that we support academia with our how we give our money away.
It'll be yes.
Yes. And so then, having said that, I'll literally see us in production completely replicate, for example, models done by central banks around growth forecasting, et cetera, et cetera. Like, we will replicate those precisely, not just in terms of forecasting, but understanding how the forecasters are thinking about the evolution of markets that will take place. So, I'm really pleased by our culture here of being very outwardly focused on what are the best ideas originating around the world and trying to bring those into what we do day in, day out, quickly, thoughtfully, and carefully.
Well, thank you both. It's certainly a question I wanted to ask just for the general audience, because I know both of you well. First time I met you each, I was amazed at both how well read you were in the academic literature. And I remember both of our first meetings, actually, where I was surprised at how many papers you could cite on the fly, including one or two I hadn't read yet. But I think this is very useful for for academics to know that this work is taken seriously and you do get ideas from this and it is helpful. So thank you both for that. So I want to drill down a little bit into two topics that are, I think, pretty specific to each of your businesses. And Ken, why don't I start with you? I want to talk a little bit about an area that academics have focused on, liquidity and liquidity provision, which is, I know, something that you deal with a great deal at Citadel Securities. Academics generally agree liquidity is important for markets and pricing. We just disagree on how to measure it. And I'm curious as to what your thoughts are on what sort of information or research you think would be most useful in pushing forward our better understanding of liquidity and liquidity provision, because I think that's a big area and one where there's a lot of room for growth.
So I think within the equity markets, I think we have pretty good data today around the world. We really do. We have every single trade out of virtually every single country in real time, on the tape, the entire set of book information, so on and so forth. You have a tremendous amount of information available to you. Now, of course, there's always the hidden liquidity in the marketplace. No one's going to show their full hand when they go to trade. No one's going to do that. Doesn't happen. But you can see the actual ex-post trading that took place and the enormous volumes that we saw transact in the marketplace throughout the course of the entire year in equities is really a statement about the unbelievable liquidity we have around the world today. Where there's much greater gaps in our knowledge are in markets where there's a lack of transparency. I mean, it is remarkable to this day that Treasury bond trades are not reported in real time to a central reporting facility. And an area that is ripe for change is to push, like we are in Europe with MiFID II, push for real-time reporting across every possible asset class so that we can have much better data to understand liquidity and changes in liquidity across market regimes. You know, other areas that we think about that may be helpful, particularly in fixed income, would be ex post access to RFQ information. So requests for quotes, a very common way in which people trade in the fixed income markets. You have a trade you want to get done. You ask 3 dealers or 4 dealers or 5 dealers to price it. We don't save all those bids and offers in an available repository for after-the-fact review to shed insight on liquidity that was available at the time. And people get very confused in markets. They go, markets are less liquid. You know, I kept hearing in March and April, May from equity traders, well, the market's less liquid in days where you saw record turnover. And what is interesting is humans have such a bias to remembering the 1 cent wide market on the calmest day of the last 5 years and trying to extrapolate that into the most chaotic day of 2020 and going, why isn't it like it was back on that calm day? And it's because everybody, both liquidity providers and liquidity takers, are only showing their partial hand at any moment in time. But in the context of the day as a whole, more turnover occurs on those days than any other points in history. And getting people to understand those two very different thoughts or that concept is very important because it helps to focus the mind on how liquidity has changed over time, the sort of use of algorithmic and slicing of large orders into smaller orders, and how much more sophisticated people have gotten at managing their information leakage. I mean, Cliff, how often do you guys talk about market impact and information leakage? It's like the only thing we seem to talk about at Citadel half the time.
Every day, and I'm usually complaining.
There you go. So that whole area is a really important area for large asset managers like Citadel, and for an asset manager who's many times bigger than we are, like AQR. How do you balance getting done what you want to get done with the information leakage that goes with it? So these are, you know, some of the salient thoughts that we have on the topic, and I think this is an area that's again ripe for research, and in particular ripe for research on where. And I'll be very clear, Citadel Securities is very focused on transparent markets. You gave a very kind introduction to the business. Let's be clear, it's a commercial business, but we believe that one of the underpinnings of successful markets or vibrant markets is transparency. that when you have a market that has a richness of information, people have more confidence in how the market functions, people are more willing to transact in such market, and everyone who's part of that market's a winner. Everybody wins. And so we are really trying to push for things like real-time reporting of treasuries. And if you look at interest rate swaps, which have gone towards real-time reporting, you see a dramatic reduction in bid-ask spreads. You see a dramatic reduction in the cost to transact. And being able to drive that point home in the academic literature actually helps to affect policy changes that we think will make markets function better for everybody over time.
Toby, if I can really just expand a little bit on two very good points Ken made. First, I said I wouldn't mention age again. It's implied in this. But when I started trading bonds, it was particularly physical bonds. Call 3 dealers, 4 dealers, get a bidder and ask. Try to remember if you want to take the low or the high, depending on if you're selling or buying. That's harder under pressure than you realize. And a lot of the market has changed and developed, but fixed income less than other places. There are more parts of fixed income that are still kind of like that, which is actually kind of amazing given the technological revolution in a lot of places. Not all of fixed income. It's not been, but closer. The other thing I wanted to, it's funny, Ken talked about people remembering the past rosier. And I've talked for years about a very similar thing. I've done, not for a few years, but you know, every once in a while when high frequency trading is coming under attack, I've been a defender of it, even though it's not what we do, because I think we trade cheaper because it exists. And one thing I'm always attacked with is kind of, you know, look how much they retreated on this day and didn't make a price when this was falling. And one of my responses is, yeah, go check out the crashes before high frequency trading. Everyone seems to remember a charitable, eleemosynary market maker who bought things at a level where they knew they'd lose money just to make markets work, damn it. And it just never existed.
No, you and I, to date ourselves, both lived through the crash of '87.
Yeah.
Okay? You couldn't walk down to the New York Stock Exchange and see every single firm out of business for having charitably bought the market down 10%.
They didn't do it.
It's a fantasy, okay?
Nobody in a free enterprise system is going to throw away money. So, you know, it's what system is best. And I think the current one has, you know, certainly the levels of prices we pay are better.
And I think the role of the market is to drive towards the equilibrium price as fast and as efficiently as possible. In some sense, like if you're buying the stock down 9 and it should be down 13, you're not doing your job for who you owe a duty to. Whether you're a money manager, you work at a bank, you work at a market maker, like you're breaching all of your duties if you're knowingly buying an asset at a price that exceeds where it should be.
So Cliff, I want to now direct a question towards you and more along a lot of the stuff that you do at AQR, which is, you know, a big part of academic research, as you both well know, is factor investing, which has many names. It's now been, you know, commercialized into what people call smart beta, alternative risk premia, and those all sorts of those things. And I think, you know, we'd like to know what's your view on, you know, the expected returns of these multi-factor models and these factors going forward, especially when you hear, you know, in light of, well, it's been so popular the last 10 years, it's crowded, there's issues of this factor zoo that academics have created too many factors and some of them don't survive out of sample. Just what, you know, your general view on this. Sure.
You know, in some sense, you are asking the fox, you know, how he feels about leaving the hen coop door open. I have an agenda here. Let me start backwards with the factor zoo. I get very schizophrenic on this because on the one hand, data mining is a serious issue. The need for theory, along with as much out of sample testing as you can have, has been driving good researchers forever, exactly in a fear of data mining. Having said that, I think that that the whole factor zoo thing still gets oversold on occasion. I mean, I think a lot of the academics in this audience will know that when you read 500 factors, I'm making up the numbers, but 500 factors have been tested. Yeah, well, 212 of them were some form of value investing. 103 were some form of momentum investing. What's actually being, those giant numbers of tests are actually about refinements and fighting about how to measure things. So I'm not saying it's not an issue, and it's one we're very concerned about. You know, some of the papers out there, McLean and Pontiff, others who've looked at replication going forward of like kind of broad-based anomaly literature. It's often presented in the financial media, to the extent anyone ever cares about academic and quantitative research in the financial media, as, wow, these people find this devastating result that you only get half to 2/3 of a back test. Well, just speaking for us, Cam Harvey will yell at us for it because he likes to not be this specific and apply the same number everywhere. But we've broadly assumed we get half of a back test going forward, back to my Goldman Sachs days. So it's always odd to see that presented as some damning thing when it's, you know, it's as good or better than I expect. Now, you can't talk about factor investing without talking about, you know, the, how many pounds is the gorilla, the 800-pound gorilla in the room, which is, I won't speak for everyone. Obviously, there's some combinations of factor. If you did only the quality factor, you've had a very good last few years. But most broad mixes of factor investing, certainly ours, and particularly driven by the value factor, which is in most people's, not everyone's, but most people's approaches, has been fairly horrific for 3 years. So blending what we talked about before with your question now, you know, we spend a inordinate amount of time, you know, this is like a levered bet in our time. We borrow time from other things to do extra work on this whole, you know, is this because they're not going to work anymore? As the dreaded, I always feel silly saying it, but has the world changed? We are of the general philosophical view that on the one hand, the world changes a lot less than it's declared to have changed. On the other hand, it does sometimes change a lot. So you can't just rely on that first one. So again, this gets back to my first answer on what research would be useful. We have admittedly taken a piecemeal approach. You know, are factors too crowded? Well, that's, you know, an odd thing to worry about when the value factor in particular that has caused most of the pain has been obliterated. And we think, and this is, I don't think by any means universal, but I think it's generally a fair amount of others have looked at this. We think it's trading quite cheaply, you know, very close to record cheaply, comparable with the peak of the GFC and the tech bubble. So the notion that a strategy that everyone hates that is trading very cheaply's chief problem is is very crowded. You might argue that that crowding, when it's reversed, maybe part, I don't think by any means all, but maybe part of the last few years has been reductions, which can have a price pressure effect, and that could certainly be true. But the idea that the strategies are permanently crowded, I think the way you would see that is spreads between cheap and expensive that are much tighter. And I'm talking about value, but this could occur for any strategy. If it's trading much more expensive than it has in the past, there could be some evidence it's been crowded out, or implementation costs going way up. You know, crowding can manifest in another way. Perhaps it's not been bid up, but every time you go to trade, there are a whole bunch of other people trading and your market impact is higher. In lieu of seeing those two things, and we don't see a big spike in our trading costs, and we see the opposite in valuations. Again, there are a million other stories for the world that's changed, and if we have time at the end, I'd take you through any of them you want. But in lieu of that, you know, good factors that have worked for us live for 25 years, back test for, you know, some of you guys out there in the audience, I know have done some of the Russian Empire work and the other fun stuff and extending these back in the past. You know, if the stories go the opposite direction than crowding, and it's worked for a long time, we just, you know, we have a very sophisticated strategy. It's called holding on for dear life and waiting to be right.
So,
just to echo a couple of things that Cliff said, half in back test, that's a win. That's a win. And anyone who thinks they're going to get 100% in back test, out of sample is out of their mind. It does not happen. I mean, random luck of the draw it will, but it will not happen as a function of, wow, you have some brilliant research process. And I'm sure, like AQR, we put a lot of time into thinking about how do we affect our research in a way that is not data mining, which is, I think, a huge problem, particularly amongst younger researchers who can test. I know, Cliff, we're looking like the old men, like this. I'm having like this T-Rex visualization.
Yeah.
And the mammals are
very short arms, kind of thing.
Yes, but our younger colleagues who are phenomenally gifted have a predilection towards data mining because they can test effectively an infinite number of hypotheses, an infinite number of parameters over an infinite number of CPUs in a very finite amount of time. Go ahead.
Sorry, I may be unpopular on this broadcast. That's mainly to academics, but everyone is susceptible to data mining. I do think Ken is 100% right. Young people, including the distant past when I was young, the tendency to, hey, let's do every kind of regression possible, and then look at is certainly there. Time doesn't remove all of that. I will tell you, I can look at other people's work and be a serious cynic on whether it's data mined. Put me in front of a computer with a big data set, I start trying things that I think are interesting. And, I think as you do this longer, you get better at that, but it never fully goes away, which is why you never assume your back test is gonna hold up going forward. But everyone looks at other people's work and goes, that's data mining, and then everyone sits down and does it themselves. So, breaks on that, assuming less going forward, making sure if your phenomenon you're studying can be applicable broader than where you've looked at it, to look at it elsewhere and being willing to throw it away if it should work elsewhere and doesn't, which means the chance that what you found was random. We can't eliminate this problem, but we absolutely know the best practices to address it.
And I think those are all really important points that Cliff just made, because in some sense, machine learning is the ultimate data mining tool and is like all the rage. If investors want to hear about your ML efforts and how you're using ML to deploy capital, and I think of it often as sort of the capital reduction process rather than the capital generation process. Just deploy your capital against an ML model and watch it disappear. And we use ML here. I don't want to speak out of both sides of my mouth, but we use it where we have, and I really focus with my colleagues on hypothesis-based research. I am old school. I want to understand a hypothesis and causality. I want causality, not just correlation. And when we have that, when we have a hypothesis up front, we see it come through in the data, we see the causality, we are far more confident that we are on a path that will lead to somewhere than just an ad hoc correlation that looks really attractive. In the area of factors, I read some of Cliff's letters to investors, and I give Cliff credit for the intellectual honesty in what he writes. AQR's had some tough runs in the last couple of years against a phenomenal history, and yet the intellectual succinctness and ownership of that is rare to find in the business. And it's important to have that intellectual clarity because it allows you to remain open to how you can improve what you do.
That's very nice again. And that balances the fact that he keeps stealing my points and saying them before me. Literally on my set of notes for this was to point out that, sometimes in the same set of questions, I get asked about how we control data mining, and then the next question is how are we employing machine learning? And I actually enjoy that because I get to point out what Ken just said. Yes, we are trying to employ machine learning for places we think it's appropriate, where we have a lot of data, where there is a theoretical reason, as Ken said, not just an empirical reason for nonlinear relationships. We think a lot of investing is not about that. If you hold for medium term, if your holding period is, on average a year, you have a small data problem, not a big data problem. So I don't think it's that applicable. So I absolutely agree with that. Machine learning is going to change a lot of the world. It may change a lot of parts of investing as a tool, particularly when you have new data sets, machine learning. It gets quite interesting, and that becomes a little bit of an arms race. Probably create strategies that, in fact, unlike some of the ones I'll defend, do have a half-life to them, because being the first to get to those is a pretty big advantage. But I think, again, we've taken it a little bit off topic to machine learning, but I think it's going to affect basic investing, be it factor investing or how the traditional active investor evaluating a company in a more old school Graham and Dodd kind of way. I think it's going to have on that part of the business less of an impact, maybe much less of an impact than many think. The very notion of what we do, the behavioral side of finance is always, people are excited about new companies. They're excited about new things. They're excited about new toys. And there's an art to using a new toy, not being dismissive of it, but using it where it applies and not overselling it to others or to yourself.
And on the note around the proliferation of factors over time, I mean, Cliff's absolutely right. I have umpteen different flavors of momentum. They're all the basic underlying phenomena. I also have the same problem that Cliff has in my portfolios. A number of these factors that have worked for years that we generally are willing to very much tilt into our books have not performed recently. And I do wonder, have we in some sense been too successful as an industry at educating investors on factors? And investors have already migrated huge sums of money into these types of strategies directly and indirectly. And in some sense, we pushed markets away from otherwise pre-existing historical equilibriums, and we're seeing that bleed out a bit over time. That's one hypothesis. And I agree with Cliff. It's an interesting question. The other is, how much are we seeing just a radical transformation of the economy led by technology? And in particular, this year alone, if you think about e-everything, we have literally accelerated e-adoption by 3 to 10 years in the course of 6 months. And a number of companies that we think of as being value businesses have been the losers on the back of this just once in a lifetime. I mean, without using my mom, but like mom all of a sudden is a customer of everything because she doesn't want to go into a retail environment. And we all have these stories, whether it's in our personal lives or our parents, of this incredible acceleration of the adoption of new ways of doing things that are not captured in historical financial models, historical time series, historical frameworks. Is this a one-time event? And then some really fun things that come out of this. If you take a factor like price to earnings ratio, how do you think about price to earnings ratio for American Airlines? There's a company that traded at I'll make it up, 12 times earnings, that in the height of the coronavirus is losing money hand over fist. Well, is American Airlines, what kind of stock on a go-forward basis through that lens? And this is where some really interesting factor questions come into play, like how much is your factors be forward-looking, contemporaneous, historically looking, particularly when you have these really interesting macroeconomic shocks that take businesses. I mean, American Airlines, from an earnings growth perspective, is like the growth stock of all times on a forward earnings growth basis. But how's the market going to think about that stock in terms of pricing it compared to Zoom or Amazon or Google or Facebook? So these are some interesting micro topics within factors at this moment in time. And having these conversations and debates come from interacting with our contemporaries who have that intellectual honesty and rigor to talk about what are we getting right and what are we getting wrong. And everybody who's been doing this for a long time is having these kinds of debates and dialogues in their four walls, as certain historical relationships just haven't worked the last couple of years.
Well, first of all, I'll echo another thing Ken said. No matter what I get to in life, I'm still tech support for my mom. I don't send a bunch of AQR people over there. She wouldn't like it. I have an undergraduate degree in computer science. I go over, try to figure it out. But it is interesting. The technological shift and the way it's been accelerated by COVID is obviously very real. Our approach to dealing with that with the traditional factors, let me focus on the value factor. It's certainly not the only one that matters. My last blog piece was talking about the other factors in addition to value. But we spent a lot of time looking at the current pricing levels. One quick mention, Ken, again, is ahead of me in this talk because one thing I was going to mention at some point is when it comes to judgment and looking at what's going on, as quantitative managers, we won't jump in and go, we got a feeling Zoom is going to go up. But we did, when the COVID hit, for instance, shift the weight on many of our value factors to more forward-looking measures. The next few years forecasted earnings, not that analysts are at all perfect, but certainly has more of a hope of getting it right than hopefully very temporary, massive negative earnings. So we actually did that change. I'm not actually sure it mattered very much. Cheap measured any way you want to measure it has not been a fun place to be. But our approach, and I mentioned this in the beginning, is, and I'd love for academia to help on this, but we don't have a singular methodology for testing. Is it different now? So we deal with one-off hypotheses, and there may be 1,000 one-off hypotheses. But what I've done, and I've written a bit about this on our website, is, all right, maybe value investing is broken for a certain subset of stocks. Let's get rid of those. Throw out the tech stocks, throw out the mega caps, which throws out, every version of the FANGs known to man. Measure value against your own industry. You can never nail industry precisely. What industry is Amazon in these days? I don't know, but you could take out a lot of the risk. And one thing, in the tech bubble, a lot of the misvaluation, not all of it by any means, but a lot of it was industry against industry. That kind of makes sense. That's why we call it a tech bubble. Currently, you can throw anything we've tried out of the sample. We can throw, Facebook, Amazon, Google, Tesla, do that systematically through time in some way that screens for the very expensive, very large companies, the tech you can throw out the whole tech, telecom, and media industry. The spread in valuation, even without taking industry bet, is, call it tied for the record. So if there is a story which we have not found but are open to for why things don't apply going forward, these giant changes may in fact be the correct poster child for what's going on now. But it's happening everywhere. Investors have bid up anything within any industry measured any way you like that is perceived as the better company. So if we have to come up with a rational story for why that's right and kind of traditional value investing is wrong, it can't be about a handful of stocks or scenarios. It's got to be much broader than that.
So you both raised really interesting points, many of which I was going to get to. We covered machine learning, we covered data. I want to focus on this aspect you both just mentioned, which I think is really interesting and something that some academics are just starting to work on, which is thinking about new ways of valuing companies. And you mentioned with everything going, e-commerce and everything, but also there's a lot of companies out there where probably their biggest asset is in fact data and data collection. You think about something like Facebook, for instance. Are those things that you want academics to sort of grapple with, of new ways of thinking about valuation? I sort of hear you going in that direction, that just simple accounting and income statement numbers aren't necessarily going to capture that. Is that worth pursuing, you think? Different ways of thinking about what assets are now valuable that, 10 years ago would have been a totally different way of thinking about it?
So we actually looked at companies, for example, with ratios of revenues to employees over the course of the last 9 months. And shocking, or not surprisingly, companies with higher revenues per employees outperformed over the course of the last 9 months. So I think we're seeing it from a where profitability is created today, the moats around intellectual property and data continue to grow. I think that is one of the great, that is the sea change of our life that continues to play out. Every single day, a Tesla on the road is recording information that helps them to improve their self-driving technology. and they shipped 500,000 cars last year, 499,000 and change. Every one of those cars is helping them accelerate their lead over the other car manufacturers in improving self-driving technology. Now, does that accrue to the valuation that you see for Tesla market as a whole? We can debate that, but you could at least see the underpinnings of an argument.
Yeah, let me just add one maybe slight twist on this. To believe, again, I'm focusing on value investing because that's been the problem child. First, as a mundane issue, these criticisms can apply to any valuation measure, but they're I'll say they're most often focused on the hallowed price to book measure in academia. And it's quite plausible book is an antiquated measure. You know, with that said, it'll probably make a roaring comeback and beat everything else in the next 3 years. But the idea that book in particular can't capture anything intangible. Now, other measures, long-term expected earnings. It's how you get that measure is always an issue, how you model that. But that hopefully does include, you know, if your information advantage doesn't one day lead to higher sales and earnings, and it has for a lot of companies up till now, it should ultimately be in the numbers. But the softer thing I want to point out, and I'm focusing on the behavioral story for value investing here. Most audiences I do not have to mention that for, they just assume behavioral stories. Anyone listening to this knows there are risk-based stories also. Again, I'm probably going to get my PhD revoked, you know, at a 26-year lag, but I'll focus on behavioral stories. The behavioral story for value is not people make obvious, gigantic mistakes that the world has no idea that new technologies happen, and they're consistently stupid. The behavioral story is they go a little too far. They see real things going on, and they pay a little too much for the ones that seem great, and they get a little too depressed about the ones that seem antiquated and done. So there is certainly a case, and I wouldn't bet a lot of money on this. I wouldn't time the markets or the factors on this, but there's certainly a case that true stories are overreacted to more than non-true stories. A true story, you know, for a value investor to be right, it's cliche to say, but it's not about bad companies. It's about bad prices. So this notion, you know, sometimes gets mixed up that the world has to be static, and none of these things have to be in flux for traditional investing to work. No, what we need is humans to over extrapolate the relatively recent, say, 3 to 5 year past. And it's an open question whether they're doing that now, but I think it's quite plausible they do it more when these things are real and are serious and will be here for a long time. But a long time isn't forever. So, you know, whether the world is changing and whether these strategies will work going forward are less the same question than I think some assume.
And I think you both
outside of finance, I see no evidence the world is getting more rational. If any of you see it, please let me know.
Well, one of the things.
Well, actually, though, part of what's taking place, and I'm going to touch that point for a second, is the ability of world-class management teams today to literally reshape vast parts of the economy we've never seen like we have in the last 10 years. I mean, think about time to market from Amazon's launch to being the second largest retailer in the United States. I mean, we literally live in a new era where a good idea can leverage more now than ever before an amazing amount of infrastructure to accelerate time to market. You know, if we have a research idea here, we have literally taken a Google data center and pinned it. That is several 100,000 cores, flat out 100%, and Google calls up and goes, hey guys, like, you gotta throttle down a little bit. Okay, but that's hundreds of millions, billions of dollars of hardware. You couldn't do this 10 years ago, 15 years ago. So one of the things that is changing the world is this unbelievable leverage that we have with ideas, and the ability, if you have ideas, to marry it with execution and bring it to market in a horizon of time that was unimaginable just 20 years ago. I mean, it's unimaginable. I can change how 20% of the U.S. equity market is traded in a single release overnight. Think about that for a moment.
And I think that's a really interesting point. And how does that change the way you approach investing in these companies and valuing these companies? I mean, one of the things we've seen too is that this trend was already happening. Both of you have pointed that out. COVID has exacerbated some of these effects as well. So we're seeing this in even more highlighted. But does that change the way you think about your models, or change the way you approach things? Certainly, in terms of measurement, I can imagine it might.
I think we're still trying to figure out how to encapsulate those concepts into our models. How do you think about literally the audacity of an Elon Musk? Is there another word you might use, Cliff?
Model to just short one stock. Never do that.
But I mean, how would you think about, like, what is your audacity factor? Because a lot of the success stories over the last 20 years have been won by those who are just more audacious. Like, they just went for it in a much bigger way.
To put what Ken said differently, I think much of my problem in the last few years is I wasn't smoking pot with Joe Rogan. Obviously, that leads to audacity and wonderful embracing of new concepts.
Well, it's sort of.
I'm detecting a bit of financial services envy of the industrial base right here. It's a rare moment in history.
Yeah, maybe. Not the industrial base growing. The industrial base he's building.
Well, I think one of the things that I'm taking away as an empiricist myself is just thinking about, and I think academia has started to do this with all the new data that's out there, thinking about new ways to measure either some of the same concepts like valuation, value investing, those type of things, or even thinking of new ways to measure not just what predicts returns or prices, but also risk, right? And so I think this is something that, hearing from both of you, I think is quite useful in terms of keep pushing in that direction, because the world has changed quite dramatically in the ways that you just mentioned. And I think that requires, whether it's speedier or better measures of these concepts or risks, but something that maybe we should all pursue. So that wasn't a question, that was a statement. Sorry, I threw that in there. But before we open it up to questions from the audience, one other piece that I wanted to tackle, switching gears a little bit here, is academics they want their work to be relevant, and they want it to affect policy. And so I'm going to throw out a general question to both of you, which is, in terms of policy research, particularly as it applies to asset management, what are some of the things that you think, and we've already touched on some of this, so I don't mean to cover the same ground. If you want to, that's fine too. But what are some of the policy issues that you think are critical that academics could provide some useful evidence on to make good and informed policy decisions?
Well, we already touched on transactions taxes, helping people understand, we're throwing away a major advantage that free enterprise has the more we make price discovery hard. Leverage restrictions are talked about still a ton. Some of that can be reasonable. Sometimes they're a little crazy, where $1 in a 2-year bond is the same thing as $1 in stocks. So it's a complicated problem, how to come up with ways to maybe put a cap on leverage that aren't quite silly. But academia is certainly in a position more than others to help with that. ESG is an interesting one. We run a lot of ESG money. More power to anyone who wants to invest that way. But policy-wise, government-wise, we are a little leery of a bunch of things becoming mandatory, because then they're not being set by investors who have both preferences for ESG and for return and risk, but by governmental committee. And I may be talking my politics here a little too much, but I'm a little cynical that route's gonna go, and that's talked about all the time.
I think, Cliff, I think the cynicism probably comes from just knowing how economically inefficient trying to achieve some of these policy goals are by having ESG mandates. A carbon tax will do far more to deal with with the efficient production or reduction of production of carbon than an ESG score from, I won't name names, that says you shouldn't buy the stocks of a natural gas producer. Like, I just don't think this is the right way to solve these really important problems that society faces. We should be trying to solve those from a policy perspective right down the fairway rather than through very, very, very attenuated indirect methods by creating ESG mandates for capital around the world.
Ken's 100% right. I've written about this. And again, you know, ESG, if our clients want to pursue it, we try to pursue it as best as possible. We just try to do it honestly. I wrote a piece explaining that, you know, the classic method of ESG, and people have others, is just exclude certain stocks. We won't invest in them. We have a running joke asking people if we're allowed to short those stocks, and they never let us do that either. But this is very upsetting to some people who invest in ESG. But obviously, if there's a subset of the market that won't own something, other people have to own more of it. And that's achieved through expected returns. The expected return has to be higher. And I point out to people that the expected return being higher on the sin stocks, which no one wants to hear because it says you have to pay a little bit to be an ESG investor. Expected return being higher is actually how you change the world. Because if the expected return is higher, fewer projects will be pursued in those companies. The flip side of an expected return is the discount rate. And anyone sitting there saying, should I pursue this project? If it has a higher expected return, you get less of it. Of course, at the very end, and I think I only had a footnote in my piece on this, but Ken is right, none of this matters that much. We're not going to move, you know, unless there was a complete divestiture of virtually everyone. Stocks are close substitutes. So if you have a small expected return advantage, ESG, I don't think is going to make a dramatic difference in those. I think people get the sign wrong occasionally. I think it will raise the expected return of non-favored stocks, but it probably won't be nearly as effective as, and we can all argue about what the right policy action, but real policy action, ESG is not a substitute for it.
And I think the right policy action, you know, if we think about sin stocks, you know, what is the right cigarette tax? What is the right tax on alcohol? What is the right tax on carbon? Figure out what you're trying to change behaviorally and bring it to Congress in a way that creates that change in the most cost-effective way for society. And let the investment community focus on having a very clear focus on its fiduciary jobs to deliver for retirees for whom this is their life's work comes home when they're 75 and 80 and 85.
Well, Ken raised one paradox I've raised many times. Two things you hear a lot often from the same people is we need a massive move to ESG, and anyone who's not a fiduciary must be a fiduciary. And they kind of never notice that these things can be at odds with each other.
And just to be clear, this is not Cliff and I saying these are not important values and important debates. It's what is the most economically efficient way for society to address the problem.
And I think, you know, hearing what you both are saying, it's as an academic topic, it's an interesting topic. It's just not clear that the investment side of things is the way to approach that, right? And there is a lot of work on what's the right way to, you know, whether it's taxes, whether it's some sort of restriction of some other kind. And I think that work is interesting, and it can tie in with all this.
And with that said, if you have certain values, there's nothing wrong with reflecting that in your portfolio. I just don't think you should expect to get paid a lot for it. And its impact on the world might be positive in your sense of what you believe in, but will likely be small compared to what
I could agree with Cliff more. You know, we manage a fair amount of money for a large religious organization, and they have certain stocks they will not invest in as a matter of their values, and 100% respect their position, their values, their point of view. I mean, it completely makes sense. It's coherent and ties in with who they are.
Now, following on the lines of policy that you think, you know, certainly would benefit the asset market, or maybe there isn't any. I'm thinking about things along the lines of two areas in particular. One is transparency, and I know both of you have advocated for this in various respects. The other, of course, is reducing, or let's say limiting the impact of crises. We've seen, certainly over the last decade plus, the government's willingness, or in fact more than willingness, to step in and try to ameliorate crises. Do we think that's going to be a bigger part of the asset management industry going forward? And are there concerns and also some benefits, and more to the point, some research academics could do that would help decide what the best policies are when we hit these environments? Because we'll have another crisis someday soon. God knows when it'll be, but we'll be here again, I'm sure, in a different way.
So I'll give you a real-time example. There was the modest funding crisis in repo in March, and repo basis widened due to the combination of both very large central bank selling of treasuries and tightness in the repo funding market. And having academics have access to information to really frame an issue like that out in a timely way is incredibly important to setting the narrative and the tone of the policy response. And time is of the essence, because the policymakers will, in some sense, be driven to a narrative by the popular press, or will be driven to a narrative by certain entrenched interests. And having facts and having academic research substantiated by really powerful facts helps to make sure that we make the right decisions as a society on what are thoughtful regulatory frameworks.
When it comes to limiting crises, I cannot let this go without doing a short libertarian rant about the moral hazard of limiting crises. We're in a tough position when it comes to crises now, because we've made it so clear in such a large way for so long that the central bank, even fiscal policy, but mainly the central bank, will, to the best of their ability, not allow losses to occur or to remain. That every time you do that, it does get harder the next time. Way back, again, I'm dating myself, but August of '98, when long-term capital began its kind of 3-month terrible time, and started out with the Russian default. Subsequent to that, we had a Fed governor speak to our firm, and the Fed, as usual, came in and did all kinds of cutting and saying we're going to help. And he said, "Yeah, I was. If it were me privately and there were no consequences, I don't think I would have done that. I would have let the chips fall, have people take losses, and understand what those are." By the way, I find it cute that 22 years later we think long-term capital might have brought down the financial markets. We've survived, orders of magnitude worse than that. But back then, that was a thing. But he said, "Yeah, if I were the omniscient ruler, I probably wouldn't do it. But look at what my payoff function is. If I lean too hard on saving the world and the world comes out okay, I'm somewhere between neutral to a hero. If it was not necessary, no one ever knows that. If I tried and the world collapses, well, I tried. But if I didn't try and the world collapses, even if my efforts are really not what would have brought it back, and even if that is a long-term positive, because people start to understand again that things have risk, I am vilified as the man who crushed the world." So it becomes quite clear. You get into a public choice kind of situation. I don't think everything that central banks do, or everything the government does to try to ameliorate crises, is all about humanitarian benevolence. Some of it might be, but some of it is looking at a loss function that's extremely asymmetric. So, explaining that, and I'll leave it to the smarter people on this call to figure out how to ameliorate it, because it's a hard one. But that's a real issue. The people who make these decisions are not facing the loss function we sometimes casually think they're facing.
And so, it sounds like certainly this kind of research, which is increased dramatically in academia over the last decade is useful and something you do pay attention to. And I think, Ken, both of you raise this in different ways. The more data, the better. The more data we can bring to bear on this, the better.
Data and time to market.
Time to market.
Time to market. Be at the table fast enough to help to set the narrative. It doesn't help us if it's 4 years after the fact and they've already passed legislation.
Right. Right. Yeah. Well, one of the things,
repeal legislation than it is to pass it.
Well, you bring up an interesting point about time to market, actually, Ken, because one of the interesting things we've seen in academia, and first in my lifetime, and I don't know if others on the call feel the same way, but with the COVID crisis, this is one of the first times, certainly first time in my career, where I saw almost real-time academic research on the impact of this pandemic. Generally, it takes several years, as you both well know, and the things come a bit late, especially when you're talking about something that needs to be resolved quickly. That hasn't happened in the last 9 months. And I'm curious, actually, how aware each of you are with some of that research and whether you find that useful, because some of that, and some of it's of very high quality, has been done very, very quickly. And, granted, it's not some of it's related to asset management. A lot of it is just general economics. But I'm curious to know what, are you guys aware of a lot of that research? And is there anything that you've seen, and it's okay if the answer is no, that has, helped you in terms of this current crisis?
So we run a large biotech investment team here. And in fact, we have several teams here focused on healthcare and on biotechnology. And they've done a great job of both reading that research and synthesizing salient points to our portfolio managers to act and react to. And then you can see I'm in my office here in Chicago. The enormous amount of research done on how to maintain a safe work environment has been incredibly helpful. It's just a very nuts and bolts practical level of running our economy. So the research that has come out over the course of the last 6 or 7 months has impacted just countless portfolio decisions. Like good estimates of R0 have been incredibly helpful trying to understand, right here, right now, the issue of the day, the South African variant. What does that mean for us in terms of possible failure, not failure of the current vaccine technology? How fast might that spread in the United States? How big of a GDP impact will that have in the race towards vaccines on one hand, assuming they work, which we believe will be the case? We don't know yet. And a faster spreading, more transmittable virus. So all this work, literally is on my desktop off of the major medical journals in near real time and impacting everything from portfolio decisions to life safety decisions to how we run the business decisions.
I got nothing useful, Dad. He has a biotech team. I got nothing.
Well, I think, one of the reasons that I think some of that research has been able to be completed in academia is, unlike other crises, this one has opened up all kinds of data where I think, everything has just been made public, whether it's the medical data, whether it's business data and other things. And I think both of you have said this in a number of different ways. The more academics can get access to some of these data, whether it's about markets and market microstructure to improve liquidity, whether it's about other ways to measure things and other data, we're willing to do it. And I think what you've seen in the last 6 or 7 months is because that was available, people jumped in and did it. So it's really great to know that it's actually being used out there. I think that's great.
Look, my only wish is it was more broadly used. Like, we've done great work in academia, and I was on the phone with some of the leading academics in the relevant fields back in March, back in April, both teeing up work to be done, funding research. My only regret over the course of the last 6 or 7 months is, as a society here in the Western world, we just didn't implement or execute against enough of this work that was really thoughtful in its nature.
Interesting. So I've gone over what I was planning to do for a lot of time, although I have plenty of more questions. But I want to pick a few questions that I've seen from the audience. Some of them revisit some of the topics we've already covered. One is about active and passive management, which and I'm curious to get your thoughts here. And it's a tough question. I certainly don't know the right way to think about it. But if you think about sort of this trade-off between active and passive, and we hit on some of these issues, there's an externality in the sense that active managers provide price discovery, At the same time, passive investing, we think for certainly maybe an average retail investor might be the right way to go if they don't know how to identify who's got skill and who's the right active management. How do you think about both those margins, the social margin of price discovery as well as the margin for the average investor, and what's the right balance there? We know it's not 100% active and 100% passive, but how do you guys think about these things, and is that useful academic research? I think more to the point.
Well, I've been joking for years. I'm not making this case seriously. I'd hate to have an excerpted headline saying, Asness wants government handout. But you could make a theoretical argument to subsidize active management, because there could be a world where, on average, the Sharpe, with my partner Lassay's paper being a small nick in Sharpe's argument, but Sharpe's argument that the average can't beat the average is still pretty strong. Some active managers, I don't think they're all noise. I think some are good and some are less good or negatively good. That's the most positive way I can put that, negatively good. But this notion, it will always have this tension that if active management isn't on average rewarded, how do we get some of it? Just to blatantly echoing some of the things Ken and I said before, step one, if you have a problem, isn't necessarily fixing the problem, it's stop making it worse. So things like short selling bans, transactions taxes, I think the essence of that question, we're ways away from trying to figure out how to make active management contribute more. The first task is how to make the policymakers not neuter it. I think it is a great question, but I think our earlier answers are step 1, 2 through 10, and then we'll deal with the next ones.
I think Cliff put that really, really well, but I'd like to just add one point. Active managers are really important to making the pie bigger. Really important. If you look at all the IPOs that took place this year, those IPOs are all funded by active managers with almost no exception. And in fact, Citadel is one of the largest investors in the world in pre-IPO biotech stocks. Again, active management making the pie bigger. The point of our entire industry is to help allocate society's capital to make the pie bigger, first and foremost. And, we talk about abstract concepts like liquidity. I'll just frame it up for you. How much money would exist in venture capital if you could never sell a share of a business you invested into?
It's funny Ken brings that up, because I just alluded to, so he doesn't yell at me, Lasse Peterson's work, I said, puts a small nick in Sharpe's math, but that nick exactly comes from things like new issues. That's a big part of his point, is index funds are not going to price those accurately, and it's one place where you can imagine alpha being injected into the system that doesn't have to balance to zero, and that's a lot of Lasse's argument that I gave way too short shrift to, because Ken actually used it.
Well, and I think related to the topic we covered earlier, which is more research about research allocation and distortions when you don't do it right, when the price is distorted or confined in some way by rules, I think is valuable research. We're seeing a little bit of that, but it sounds like we need a lot more of it.
Look, we're a huge trader of commodities around the world. In fact, one of the largest physical shippers of natural gas on the West Coast of the United States. Price signals dictate where wells get built. Price signals dictate where storage fields are created. Price signals dictate what kind of power plants are engineered and put into production. And I put this in terms of commodities because it's really easy to understand. The farmer sees the price of corn, of soybeans, of wheat, and can make a straightforward decision what to plant on their land that year. And I put it in commodities terms because when you put it in commodities terms, it just goes right back to, it allows the farmer to take advantage of all of our research in helping to make the most important decision he will make that year, which crop to produce, and he can manage the price risk of what he produces with a simple trade in the futures market.
So I'm switching gear. Another question that came up relates to machine learning. So I want to come back to that topic for a second, which is, and you both talked about it, which is you don't view machine learning as necessarily revolutionizing the industry, but you're both investing in it in your firms in some way. Where do you see might be the biggest benefits of using machine learning? Is it signal-related research? Is it maybe on risk and risk measurement or trading? What are some of the places where you're investing some research broadly in this particular area?
I mean, for us, I have no overarching theory. I mean, certainly some of the characteristics, it has to be a lot of data, with many decisions to be made. Again, some will use machine learning without any idea of or intuition or theory behind it. Both Ken and I have said that we greatly prefer to use it in a way we think we can understand, which is sometimes a challenge with machine learning, to extract the logic from what it's doing. But just by way of an example, one of the first places that we've used it, and I think it's been effective, we have used it in predicting credit defaults. We think there are a lot of nonlinearities there, and we can tease out from the machine learning which ones it's doing and see if we think they're economically reasonable. Another place we've explored it is a very mundane thing. It's not a huge cost, but it's a cost rolling positions. There's not a lot of theory to that one, but you have a ton. We do a ridiculous amount of rolling of positions, so it has a very big data aspect to it. And if there's a pattern there that's very consistent, I might be willing. Everything's a point on a spectrum. If the empirics are extremely strong, I still want intuition, but I need it less. If the empirics are okay, I need more intuition. So for us, I can't give you these are the places that'll be useful, but we are going through the problems we face, picking our spots, and finding it does help in some places. It's just not a panacea for picking the next Google.
And I think Cliff used the right key word, where there's ridiculous amounts of data. That's where it really shines through. And, we do have data sets here that are measured in petabytes. And when you have petabytes of data, you have the opportunities for ridiculous amounts of data. I think there's a lot of machine learning applications today. There's just not enough data to feed the engine. And people are lured into thinking that what they're doing has substance, and it just doesn't. There's not enough data there. You're better off in the world of just simple regressions and understanding the problem from a holistic perspective than just relying upon what the machine kicks out the other end of the process engine.
And let me follow up on that to both of you. Is there academic research in machine learning that would be helpful in terms of, the methods are actually quite old. It's just that the technology and the data finally became available to make them useful. But there's a lot of academic research starting to focus on that. And what kinds of research would be helpful to you? They're not, academics are not going to have petabytes of data, but they can look at ways of using machine learning that might be useful to you. Is there any directions that you think, and just speculating off the top of your head, where that might be useful?
How to bridge this thing that both Ken and I keep raising of using machine learning, but not throwing out all ability to know why it is doing what it's doing. We're in its infancy there, and we can use as much help as possible. I also think, again, to echo things that Ken's been saying, that something we are excited about, but we still think is overhyped. I don't want to criticize everyone listening to this, but sometimes academia can add to that overhyping. Everyone wants to write the next paper on machine learning when there's still, basic things about, liquidity and trading and financing that we don't understand. So you don't have to be negative on it, but some perspective to let the world know what we can gain from this and what maybe is overselling would be useful to come from academia also.
I mean, machine learning is changing the world. We all know this. Look at protein folding. Machine learning is making some of the most important impact in that field ever made. Self-driving cars, machine learning is making that impact. Now, what's interesting, the self-driving cars in the north really struggle as compared to in the south. Snow. All right. So where the underlying process is stationary, machine learning is much more powerful because it's able to find the patterns. snowstorms wreak havoc on machine learning with respect to using cars. I'm still looking for the businesses that we invest in that are stationary.
That's exactly right. Take a non-finance example of, like chess. The Alpha Zero stuff, I'm not a great chess player, but I look at that and it's freaking amazing. Because chess is a huge data problem. There's tons of potentiality of moves is gigantic. The number of games to study is gigantic. And that thing now dominates other chess programs. And what was very exciting to us 20 years ago with Kasparov and Deep Blue, it's not a contest anymore. Again, problems like what basket of stocks I should own for a 2-year period. That ain't chess. That's closer to a snowstorm.
So another question that came in, which is one that we haven't covered, I thought was interesting, is given the uncertainty in markets and the importance of stress testing, in terms of research, how much research are you putting into things like risk management, stress testing scenarios, especially given what we've been through in the last 12 years? Has that research, in your opinion, at least at both of your firms, soared over the last decade? Is that something that's a big part of your research efforts as well? And are there things that we could do in academia to help with that?
It's a big part, but I think it always has been. Every crisis will inspire you, and you don't want to overlearn the lessons of a crisis, but they're usually a few things. For us in multi-factor investing, it's not volatility that's been surprising. I admit this. We know the world is fat-tailed. Very often practitioners and academics, I have to say, get accused by kind of academic or quantitative critics of naively assuming the whole world is normally distributed, which I don't think anyone on this call would make that assumption, and probably quite the opposite. But there's been no day, no week that has particularly shocked me. Even some giant standard deviation events, we've always seen that at the daily level. If you asked me 3 years ago, would I expect a 3-year run for multi-factor investing like this? I would have said no. I'm smart enough to accurately say it's not impossible, and if it happens, we're going to evaluate what we do and see what it looks like going forward. I think it does, by definition, presuppose that the opposite can happen, which I would like to start now if anyone has any, ability to help on that. But it's made me look a little bit more at the idea that strategies might trend even more than we thought. We think everything tends to trend a little bit. And that's a form of risk control. It's a form of long-term risk control. It's about long-term drawdown control. We often think of risk control as fire, but it can be ice too. It could be losing at a shallow rate for a long time. And I no answers yet, but the last few years have made me at least more open-minded to considering some of that stuff. I will probably implement it within an hour of when I shouldn't. Not a minute, I'm not that bad, but within an hour.
Well, one other thing about risk management and this actually relates to another topic on transparency, is we know there's externalities in terms of risk, especially if you're trading in positions that might be correlated, when there's leverage involved and other things. Are there things that, would help you from either a data perspective, where there was some, central pool that somehow let you know what your exposures were a bit better? I mean, the government has struggled with this, or the exchanges have struggled with this on the other end. And, simultaneously, is there academic research, perhaps using that data, that can help in terms of providing better risk management? I think that's one of the things that people always struggle with, is what market am I entering into, and what's everybody else going to be doing at the same time? Because if we all try to go through the exit at the same time, it's a disaster. So are there things that we can do to help here?
Well, one thing that would help me a lot is if Ken would just give me 10 minutes notice before he's going to do a big trade. Actually, I wouldn't know what to do with that information. But I can't think of any. Maybe Ken can. I can't think of any, giant ask. on our part. We have, obviously positions, we have our own positions analyzed every way through Sunday. It would be nice to know everyone else's, but that would not be particularly fair. So, I think we have the information we need for risk management. I think the dynamics of markets are just something that we still don't collectively fully understand.
Well, I think the trepidation around central risk repositories is, what if there's a leak?
Mm.
In a moment of crisis, having your positions leaked to the world as a whole is game over.
Well, and this is the tension, right? Which is transparency has efficiencies associated with it socially, but there's potentially a big cost, right? And so you have this, we want markets to be functional and transparent. At the same time, you can't have it destroying for, you don't want your positions leaked. Someone can take.
Well, that's actually a different point though, Toby, which is effectively our positions is how we monetize our research. All right. It's just that simple. If I cannot get a position in place, then there's no point doing the research because I cannot monetize it.
Right.
And if you look at the size of the AUM of all the large asset managers, it takes time to accumulate a position. If I had to disclose my position every single day, the value of my research would be greatly impaired. And all the gains, right.
One thing I point out, a lot of these things like aggregating data and putting it all in one place, maybe makes things better in a median or mode sense, but makes disasters worse. There are a lot of things like that. The post-GFC move to more clearinghouse, to them playing a more central role, that probably reduces the probability of disasters decently. Maybe a ton. Maybe it's worth it on net. But if there is a disaster, it's probably 14 times worse. So there are a lot of things that kind of have that characteristic, that we can reduce the frequency of disasters, but increase the severity if they do occur, like all things, because if they do occur,
actually,
a shocking event.
So as a firm that worked in architecting the central clearinghouses post-GFC, I'm going to have to take the other side of that argument, which is...
It was hypothetical.
Hypothetically, there's a very, first of all, 14x is just like the raw multiplier. Number two, the moral hazard of bailing out a central clearinghouse is night and day different than the moral hazard of bailing out a major bank.
That's fair.
And I do know.
Ken and I have disagreed, and he's right. I'm not going to try again.
So, obviously this year has been a really interesting moment in time in terms of risk management. We now have the 2020 stress test as part of our business going forward. That'll be true for all of us. I wonder if it'll roll 87 off of our list, Cliff. It's an interesting question. But we do have a really interesting stress scenario that represents, March this year in the financial markets, March of last year in the financial markets that will carry forward. That will be a stress test that everybody will talk about. And investors will ask, how's your portfolio do in a repeat of March of 2020? So it'll forever change.
The Dutch tulip bulb craze from our stress test. So it's going to be a while till the crash of 87 goes.
And then, all these periods
a new data point
of extremely high volatility really make one think about, if I think about, for example, the annual volatility of my portfolio, how do I think about that where some part of my portfolio, either it's options and expires or it's futures and I have a roll date, evolves in a very clear way over the next 8 weeks, and yet I have a whole year of risk I'm trying to think about. There's not a lot of work done in the academic literature in helping managers think about the fact that your risk problem is a multi-period problem. And the amount of risk your portfolio has at any point in time is, number one, is changing beneath your feet by just the nature of time. And then number two, changes expectationally as vol surfaces evolve over time. And that was really an interesting issue for us in March, in April, and May in thinking about giving guidance to our portfolio managers on the amount of risk that they were to take in a very rapidly changing set of market conditions.
That's very interesting. So we're just about out of time. I know we said 90 minutes. We've already exceeded that. Any parting thoughts either of you want to say? And after that, I think we'll just adjourn. I've covered as many questions as I could in the Q&A, but very thankful for your time, and I think there's some great directions for future research. So I'll leave you guys a minute if you want to say anything. If you don't, that's fine too. Anything else that we didn't cover that you wanted to say?
I will just encourage everyone attending this and listening to keep writing great research so we can keep stealing it.
Toby, I'd like to thank you for moderating a great conversation, and I'd use All right, both of you have a healthy and happy New Year, and to everybody who joined us today, wishing you the same. Take care.
Cliff and Ken, thank you so much. Thank you very much for your time. It was really insightful. Thanks.